Hello there, welcome to a demonstration on how to perform a balance sheet common size analysis. Right, so there are various tools and techniques that can actually be used to convert financial statement data into formulas that can be used for the purpose of evaluating a firm's financial condition and performance. Again, this can be performed both over time or in comparison with industry competitors. Now, the tools and techniques include common size financial statements, which express each account on the balance sheet as a percentage of the total assets, right? And in many cases, we always want to perform this over a number of years. Then that way we can actually begin to see any trend that can actually emerge from that. Again, this requires the evaluation of financial data over several accounting periods, and you tend to find that the structure of the organization will kind of emerge from this very almost simplistic picture, right? Because we're not doing complicated calculations. We are simply expressing each line as a percentage of the overall value. In this particular case, the total assets. That's all we are doing. But it's just amazing how much can actually come out of that, because you can begin to have a feel of what type of an organization this one is. Are they overly reliant on a certain type of activities? For example, if they're heavy on inventory, that will show you that the bulk of their assets are actually kept in the inventory. Or maybe they are much more heavier in, let's say, equipment. Maybe they're more into manufacturing. That will actually show you that. So by just taking a quick look at a glance at how all those different lines can relate to the total assets, that gives you a very important picture, which can as well be a logical beginning point to kind of understand the organization itself. So again, this technique involves representing each asset, liability, and the equity item as a percentage of total assets, offering a comprehensive and standardized view of a company's financial position and changes over time, especially if you run that over a number of years. So here we have a balance sheet for a, for a sample organization. It's just hypothetical numbers here, right? As you can see, we are not in 2024, but we are actually assuming that this particular organization has already lived until then, right? So that really shows you that these are just some test numbers, just to give you a feel of how you can perform a balance sheet common size analysis. Now, without further ado, let's take a quick look and see how this particular organization actually looks like. If we begin with the current assets themselves, we can see that the total current assets, right, make up more than half of the overall assets in this particular organization, with the inventory actually leading. So which means this type of an organization is pretty heavy on inventory. They need to carry inventory in order for them to survive, right? But again, carrying a lot of inventory is not a big deal as long as we are actually able to measure how quickly are they turning over that inventory. So at a given time, you could be holding a lot of inventory, but the inventory is actually moving fast. But if the inventory is slow moving, then that becomes a symptom of something else. Then that becomes bad inventory, right? So it's important to think about that whenever you're analyzing financial statements. So here again, we can see our cash and cash equivalents was higher the previous year, and comes down by about 4 percentage points in 2024. The same is true for accounts receivable, right? So they're holding less accounts receivable compared to the previous year. So once again, all these line items, whether they are lower or they are higher, it's actually dependent on how efficiently they're actually being managed, right? How quickly are you generating the cash? How quickly are you collecting the money from your debtors? How quickly are you turning over the inventory, right? Is what really matters at the end of the day. So again, our total current assets, more than half of for the total assets. But what is actually also important when you're actually looking at total current assets here, you also want to compare them with the total current liabilities, right, down here, because you also want to make sure that you've got more current assets than total current liabilities, because this is what you use to pay off your debts, right? So you also want to make sure that you are liquid as an organization. So again, that's again a discussion for a totally different recording where we generate some financial ratios that will measure the liquidity of an organization. You always want to make sure that you've got more current assets than current liabilities, which means that you'll be able to pay off your creditors and still remain with some money, continue to run your operations. Now, what else do we have here? When we look at the fixed assets, here we can see that the fixed assets grew by about 8 percentage points, which means we acquired more fixed assets. Okay. Then again, is it a problem or not? It's all dependent on how efficiently we are using those fixed assets. Again, there are financial ratios that are actually used for that particular purpose to measure how much are we getting for every dollar we invest in our fixed assets, right? So again, whenever you're actually looking at financial statements, you're constantly thinking about how efficiently we are using the money that we're actually investing in all those different categories. Otherwise, just looking at the number itself does not mean much until you actually get to a deeper level where you are actually able to analyze that, evaluate it, and see how much efficiency is actually associated with each particular line item, right? So again, you can actually tell that I've got quite an extensive background in this particular area, because I actually once worked for a Fortune 500 company as their budget and planning manager, and of course it was my responsibility to interpret financial statements to be able to see any red flags, generate those financial ratios to make sure that we do not overlook some red flags that may eventually bring down our business, right? So again, whenever I'm looking at these numbers, I'm always looking several steps ahead of those numbers so that we can actually at least anticipate what sort of question would be a relevant question for each particular situation. Now, what about on the liabilities and stockholders' equity side of things? We can see here that accounts payable grew up by 5 percentage points over the last 2 years, right? Is that a problem or not? Well, when we actually look at, maybe it was cheap money we were actually able to access, right? Because at the same time, we were actually collecting our money better, right? So, which means that, accounts payables, if we're able to negotiate good terms with our creditors, there's no problem with that. And again, if our business is actually growing, of course, we need to increase those types of activities. Accrued liabilities stayed about the same. Income tax payable about the same. Short term. So there's nothing that really stands out there. And again, when you actually look at the total current liabilities, they stayed about the same when you compare to the previous year. So because the net effect of the 5 percentage points in our accounts payable did not really turn out to be too significant in this particular regard. Right, what about long-term debt? Here we can see that it stayed about the same. And of course, the total liability stayed about the same. So, really, what was so significant in this particular area here? It looks like our stockholders' equity is looking really good there, right? Reduced our common shares, but of course, it looks like the retained earnings for this particular organization is pretty good, right? It's quite significant when you actually look at this. So the money, our internal money, which is retained earnings that is actually building our equity, has actually been a significant portion of the liabilities and stockholders' equity section of our balance sheet, which is pretty good, right? It means that we're actually building equity as an organization. So you can see the common size approach to analysis can just give you a big picture perspective, but of course not enough for you to begin to make some specific decisions. That's why I was so quick to kind of highlight that if you see any numbers that appear to be large or a huge jump for each particular type of line, you have to look at it within the context of that particular line. What does it actually mean? What are the possible implications? And what is that actually telling us before you get too excited about it, right? Okay, so again, you can actually see that at least, it gives you a big picture perspective. I imagine you just joined an organization, maybe you are in senior management, and you say, well, can I see your financial statements for the last 5 years? And just did a quick calculation of the common size just to have a big picture perspective. Oh, wow, we seem to be inventory-driven kind of organization, but how efficient are we in turning over that inventory, right? Looks like our cash has actually been coming down. That may not be good. We need enough cash. Maybe we put that cash in our investments, right? So you can actually begin to ask important questions that can begin to force people to have some insights about how the organization is currently operating. Because remember that when you're actually looking at numbers like this, they are all historical, right? They're already actual numbers. They're supposed to be actual numbers that you're just looking at. Things have already happened, so it gives you a sense of what has actually happened in the past as you begin to participate in helping the organization move into the future. Otherwise, that's all I have for you. I hope you found this demonstration interesting, and hopefully it gave you an upper hand in understanding how you can have a quick understanding of an organization by just looking at their financial statements in a much more simplified way, just to kind of have a sense of the structure of this particular organization anytime. By just looking at this, you'll be surprised how much you'll be able to learn. Otherwise, that's all I have for you. Again, if you like the video, go ahead and like it and share. And of course, be sure to subscribe to the channel. Thanks so much for watching, and bye for now.